Welcome back to the Retail Revolution lecture series. In this video, we'll discuss the 6 pillars of excellence. The fundamental question in retail analysis is straightforward. Why do companies like Lululemon thrive while department stores collapse? Why does Costco generate exceptional returns while other retailers struggle to survive? Why does Aldi expand aggressively while traditional supermarkets stagnate? The answer lies in 6 critical pillars of excellence that distinguish successful retailers from failing ones. Winners possess all 6 characteristics. Losers are missing 2, 3, or more. This is not a spectrum where strength in one area can compensate for weaknesses in another. Each characteristic is necessary, and only the complete set is sufficient for sustained competitive advantage. These 6 characteristics are strategic clarity, customer obsession, operational excellence, innovation and adaptation, financial discipline, and brand strength. Every successful retailer demonstrates mastery in all 6 areas. Missing even one creates vulnerability. Missing multiple characteristics leads to inevitable failure. The following analysis examines each characteristic in detail, with concrete examples from both successful and failed retailers. Strategic clarity, defining your target customer and value proposition. Strategic clarity requires a precise answer to 2 questions. Who is the target customer, and why should they choose this retailer over alternatives? This seems elementary, yet many retailers fail at this foundational requirement. Strategic clarity demands 3 elements. First, a specific target customer segment rather than an attempt to serve everyone. Second, a unique value proposition that articulates clear differentiation. Third, explicit positioning that defines how the retailer differs from competitors. Lululemon exemplifies strategic clarity. The target customer is precisely defined. Active women aged 25 to 45, yoga enthusiasts with premium lifestyle orientation and high disposable income. The company does not attempt to serve all athletic wear customers. The value proposition centers on technical athletic wear that delivers elite performance while maintaining aesthetic appeal for everyday wear, positioning athleisure as a lifestyle choice. The positioning emphasizes premium quality, community engagement, and wellness lifestyle branding. This strategic clarity enables Lululemon to charge premium prices because the target customer segment values the specific benefits offered. The stores feature limited plus sizes and constrained men's sections, choices that alienate some potential customers. However, this strategic focus creates exceptional loyalty among the target demographic who perceive that Lululemon understands their specific needs. The strategy accepts the risks of excluding market segments to achieve dominance within a chosen niche. Department stores represent the opposite case. Consider Macy's. The target customer is undefined. The store serves teenagers seeking prom dresses, parents purchasing kitchen items, professionals buying business attire, and seniors shopping for various goods. This lack of focus reflects the erosion of their historical positioning as "Where America Shops," a slogan that made sense when retail was less fragmented, but has become meaningless in the modern landscape. The value proposition is equally unclear. The stores carry inventory without a distinctive reason for customers to shop there. The positioning falls into a problematic middle ground. Neither discount nor premium, neither specialized nor comprehensive. Customers can access the same brands through online channels or specialized retailers, eliminating any compelling reason to visit department stores. The fundamental lesson is that clarity creates the foundation for premium pricing, while confusion drives commoditization. Successful retailers identify precisely whom they serve and why those customers should choose them, then execute relentlessly against that strategic vision. 2. Customer obsession. Prioritizing long-term customer value. Customer obsession extends beyond customer service to represent a fundamental organizational orientation. This characteristic encompasses deep understanding of customer motivations, frustrations, and desires beyond basic demographic data. It requires continuous improvement based on customer feedback, long-term thinking that prioritizes customer satisfaction over short-term profitability, and employee empowerment to make customer-centric decisions. The business case for customer obsession is compelling. Customer acquisition costs are 5 to 7 times higher than retention costs. Customer lifetime value represents the primary source of sustainable profitability. Loyal customers demonstrate greater forgiveness of mistakes, provide valuable word-of-mouth marketing, and show reduced price sensitivity. Amazon provides the paradigmatic example. The company's first leadership principle is customer obsession, explicitly prioritizing customers over competitors or shareholders. Amazon famously maintains an empty chair in meetings to represent the customer's presence in all strategic discussions, serving as a constant reminder that customer interests must inform every decision. Amazon regularly implements policies that reduce short-term profitability to enhance customer satisfaction. Free returns impose costs on Amazon, but increase customer confidence and loyalty. The company occasionally instructs customers to keep products while issuing refunds when the cost of processing returns exceeds product value. Amazon Prime shipping operates at a loss, yet the customer loyalty it generates justifies the investment. Costco demonstrates similar customer obsession, achieving a 90% membership renewal rate. This retention stems from unwavering commitment to member value. Costco maintains a strict quality policy. If product quality declines, the company discontinues the item regardless of profitability. A notable example involved popular jeans that generated strong revenue. When quality deteriorated, Costco stopped carrying them rather than compromise member trust. The return policy is remarkably generous, accepting returns on virtually any product, regardless of time elapsed. While some customers abuse this policy, Costco accepts these costs to maintain member satisfaction. Sears illustrates the consequences of abandoning customer focus. The company allowed stores to deteriorate with outdated facilities, poor maintenance, and shabby appearance. Customer service declined severely, characterized by long wait times, unhelpful staff, and frustrating experiences. Management ignored customer feedback, prioritizing cost reduction over customer experience, despite clear signals that the shopping experience had become unacceptable. When retailers abandon customer obsession, customers leave and rarely return. Customer obsession, prioritized over short-term profit maximization, creates the foundation for long-term success. Treating customers as valued partners rather than revenue sources builds sustainable competitive advantages. 3. Operational excellence, building efficiency advantage. Operational excellence represents the least visible but most critical characteristic. This involves ruthless efficiency, flawless execution, and systematic waste elimination. The components include inventory management that ensures the right product reaches the right location at the right time, avoiding both excess inventory costs and lost sales from stockouts. Supply chain optimization minimizes the time and costs of moving products from manufacturers to customers. Labor productivity leverages cross-training, intelligent scheduling, and appropriate automation. Cost control eliminates waste without sacrificing quality. Process excellence ensures consistent, reliable system performance. Operational excellence is essential because retail operates on thin margins. Grocery retailers typically achieve only 1 to 3% profit margins. Waste and inefficiency quickly eliminate profitability. Superior operational execution becomes a competitive requirement for survival. Aldi demonstrates mastery of operational excellence through systematic efficiency. The company carries approximately 1,400 SKUs compared to 40,000 SKUs in traditional supermarkets. This limited assortment simplifies inventory management, reduces waste, accelerates restocking, and enables smaller store formats with lower rent costs. 90% of products are private label under Aldi's own brands, providing higher margins, better quality control, elimination of intermediaries, and simplified supply chains. Store design maintains products in original shipping boxes on pallets, eliminating unpacking and shelving labor. Restocking simply requires rolling out new pallets. The company does not provide bags, requiring customers to bring their own or purchase them, reducing costs while supporting environmental objectives. Shopping carts require a quarter deposit for release, eliminating the need for staff to collect carts from parking lots. Employees receive cross-training to perform all store functions, cashier, stocker, manager, creating maximum flexibility with minimal staffing. These operational efficiencies enable Aldi to price groceries 20 to 30% below traditional supermarkets while maintaining superior profit margins. The company succeeds not through quality reduction, but through operational excellence that eliminates waste throughout the business model. Walmart built its competitive advantage primarily on supply chain excellence, investing billions in technology, distribution centers, and logistics infrastructure. The company pioneered RFID tracking, data analytics, and vendor partnerships. The distribution network enables faster and cheaper restocking than competitors can achieve. While not glamorous, this operational capability provides a massive and sustainable competitive advantage. Bed Bath & Beyond exemplifies operational failure. Stores were cluttered and difficult to navigate, with overwhelming inventory, creating poor customer service. Operations were inefficient, with high labor costs, complex inventory systems, and pervasive waste. The company trained customers never to pay full price through ubiquitous 20% discount coupons, destroying the margin structure. The inability to achieve operational efficiency prevented the company from competing on price while maintaining profitability. Operational excellence may lack glamour, but it's essential for survival. In commoditized categories, the most efficient operator wins. Retailers competing on price must achieve operational excellence or face inevitable failure. 4. Innovation and adaptation, embracing strategic evolution. Innovation and adaptation represent the willingness and capability to evolve. This proves particularly challenging for established companies because it requires cannibalizing existing success. However, the alternative to evolution is extinction. This characteristic manifests through several capabilities. An experimentation culture embraces new initiatives, learns from failures, and iterates rapidly. Speed to market enables faster movement than competitors. Technology adaptation integrates new tools that enhance customer experience. Business model evolution modifies revenue generation as market conditions change. Cannibalization willingness replaces successful products before competitors make them obsolete. Innovation and adaptation are critical because yesterday's successful strategies fail tomorrow. Markets evolve, customers' preferences shift, and technology advances. Organizations that remain static face inevitable displacement. Warby Parker demonstrates exceptional innovation and adaptation. The company launched in 2010 as an online-only eyewear retailer with a disruptive model, selling glasses for $95 instead of the $300+ charged by traditional optical retailers. However, customers hesitated to purchase eyewear without trying frames first. Warby Parker addressed this with an innovative home try-on program, shipping 5 frames to customers for free trial. Customers try the frames at home, return unwanted options, and purchase their selection. This approach was unprecedented in the eyewear industry. The company then recognized that some customers still preferred in-store shopping experiences. Rather than protecting their online model, Warby Parker opened physical retail locations, accepting cannibalization of online sales to serve customer preferences. The company now operates over 200 stores with seamless integration between online and offline channels. Customers can purchase online with in-store pickup or try frames in-store while ordering online. Further innovation includes a virtual try-on application using smartphone cameras and AI to show how different frames appear on customers' faces. Continuous innovation remains central to the company's strategy. Target faced potential obsolescence similar to Kmart and Sears, but chose to evolve. The original positioning as a discount retailer competing solely on price transformed into expect more, pay less, combining design with value. Innovation included designer collaborations with Isaac Mizrahi, Missoni, and others, elevated private label brands, substantial investments in digital applications and e-commerce, implementation of same-day delivery and curbside pickup, and store redesigns creating boutique aesthetics. The company maintained competitive pricing while adding design and experience elements, enabling survival and growth while competitors failed. Toys R Us provides a cautionary tale of innovation failure. In the early 2000s, e-commerce was emerging and Amazon remained small. Toys R Us possessed every advantage: strong brand recognition, established relationships with toy manufacturers, and extensive physical retail presence. The company could have dominated online toy sales, but failed to invest in innovation. Instead, Toys R Us contracted with Amazon to handle online sales, essentially conceding the digital channel. Amazon leveraged this partnership to learn the toy business, then launched competing toy sales directly. When Toys R Us recognized the need for digital competition, Amazon had built an insurmountable lead. The 2005 private equity buyout added $5 billion in debt, eliminating resources for innovation investment, even had management desired it. The company liquidated in 2018 with a beloved brand destroyed through failure to innovate. The lesson is unambiguous: innovate or face obsolescence. Organizations must not protect declining business models. Successful retailers cannibalize their own achievements to build next-generation capabilities before competitors force the change. 5. Financial discipline. Managing capital strategically. Financial discipline involves intelligent capital management. This does not mean avoiding investment or minimizing spending, but rather strategic and disciplined capital allocation. Components include conservative debt levels that avoid over-leverage, strong cash flow that is predictable and positive, smart expansion that grows strategically rather than recklessly, capital allocation directed toward high-return opportunities, and balance sheet strength providing financial cushion for economic downturns. Financial discipline is critical because debt constrains strategic options. When disruption occurs, and disruption is inevitable, companies require financial flexibility to adapt. Organizations directing all cash flow to debt service cannot invest in innovation, cannot weather downturns, and face severe strategic constraints. Costco exemplifies financial discipline through conservative practices. The company self-funds growth, avoiding excessive debt by financing expansion through operational cash flow. The membership model generates $4.2 billion annually, in highly predictable membership fees. These fees represent nearly pure profit as the companies sell merchandise at near cost to provide member value. The business model creates predictable revenue independent of any specific product category. Expansion follows disciplined criteria, with new stores opened only when return on investment is assured. The company does not pursue growth for its own sake, but requires each location to meet financial standards. Strong cash reserves provide capacity to navigate challenges. During the COVID-19 pandemic, when many retailers struggled, Costco's financial strength enabled steady operations. Financial discipline creates strategic flexibility. Toys R Us demonstrates the catastrophic consequences of financial indiscipline. In 2005, private equity firms KKR, Bain Capital, and Vornado acquired Toys R Us for $6.6 billion through a leveraged buyout structure. The buyers contributed $1 billion in equity and financed the remaining $5 billion through debt assigned to Toys R Us itself rather than the acquiring firms. This debt structure required approximately $400 million annually just for interest payments, not principal reduction. While Amazon invested billions building e-commerce infrastructure, Toys R Us directed every available dollar to debt service. The company could not invest in online capabilities, could not renovate stores, could not implement new technology, and could not pursue any strategic initiatives. The debt burden made the company completely inflexible during a period of massive industry disruption. Liquidation occurred in 2018 with a strong brand and market position destroyed by unsustainable debt. Debt functions like fire, useful when controlled, deadly when not. Financial discipline equals strategic flexibility. During disruption, companies with strong balance sheets survive and adapt. Over-leveraged companies fail. This principle applies equally to corporate and personal finance. Excessive debt constrains options and limits strategic responses in changing conditions. 6. Brand strength, creating emotional connection. Brand strength creates emotional connections with customers that transcend transactional relationships. This characteristic requires clear brand identity with distinct personality and values. Emotional connection, where customers perceive relationships rather than mere transactions. Differentiation that meaningfully distinguishes the brand from competitors. Brand consistency through reliable delivery on promises. And community building that creates belonging rather than simply acquiring customers. Brand strength matters because strong brands command premium pricing, create loyalty that transcends individual products, and weather mistakes more successfully as customers demonstrate forgiveness. Weak brands compete solely on price in a destructive race to the bottom. Lululemon does not sell yoga pants, but rather a lifestyle. Brand strength was built through community-first strategy. Before extensive product lines existed, the company built community through free in-store yoga classes and partnerships with local yoga instructors as brand ambassadors, creating environments where customers felt genuine belonging. Store employees are designated educators rather than sales staff, with responsibilities focused on helping customers find appropriate products rather than maximizing transaction value. The brand positioning centers on wellness, self-care, and mindfulness, with yoga pants serving as tools for this lifestyle rather than the core product. Purchasing Lululemon means buying into an identity and community. Premium pricing exists because of brand value rather than despite it. Customers can purchase functionally similar yoga pants at lower prices, but Lululemon products signal commitment to quality, fitness, and wellness. Customers willingly pay premium prices because of brand associations. The result? gross margins exceed 60%, intense customer loyalty, and emotional attachment to products that would typically be commodity purchases. Apple represents the ultimate brand strength case study. Customers do not merely purchase Apple products, but identify as Apple people. Customers camp overnight for product launches, pay prices 2 to 3 times higher than competitors, and defend the brand with remarkable passion. This occurs because Apple created a community of people who value design, simplicity, and innovation. Purchasing a MacBook means joining a community, not simply acquiring a computer. Sears once possessed exceptional brand strength. Where America Shops positioned the company as an iconic American institution. The Sears catalog enabled retail access for rural America. However, the brand was allowed to decay. Stores became shabby, customer experience deteriorated, and the brand became associated with low quality and poor experiences. This created a reinforcing negative cycle. Declining brand equity led to fewer customers, which reduced investment capacity, which further damaged brand perception, which drove additional customer losses. Once a brand becomes associated with failure, recovery becomes extremely difficult. The Sears brand transformed from representing where America shops to symbolizing bankruptcy and failure. Brand strength enables premium pricing and customer loyalty. Building strong brands requires years, but destruction can occur rapidly. Retailers must invest in brand development as a business imperative, not a discretionary expense. The pattern across successful and failed retailers reveals a critical insight. The most successful retailers possess all 6 characteristics simultaneously. Costco, Lululemon, Aldi, and Amazon demonstrate mastery across strategic clarity, customer obsession, operational excellence, innovation and adaptation, financial discipline, and brand strength. Failed retailers consistently lack multiple characteristics. Bed Bath & Beyond failed in operational excellence, innovation, and financial discipline. Sears failed in customer obsession, innovation, brand strength, and financial discipline. Toys R Us failed in financial discipline and innovation. The pattern is consistent and predictive. Strength in some characteristics cannot compensate for weaknesses in others. All 6 characteristics must be present and functioning effectively. This framework applies whether analyzing public companies, evaluating retail investments, or developing business strategy. The fundamentals remain consistent.